Hello and welcome to today's lesson. I'm your hard-working but indefatigable teacher, Mr. Burton. You will need to watch this video and take notes as you go. You may need to watch certain parts of the video a few times to ensure complete understanding. This is your homework and I will check your notes tomorrow before we get started. I hope you learned something.
Okay, hello and welcome to today's lesson. Today we move on from aggregate demand and we start beginning to look at aggregate supply. Aggregate supply, a little bit bigger, a little bit more complicated than aggregate demand, so we're going to divide it up into a few parts. Today we are looking specifically at short-run aggregate supply. So we need to make a distinction between short-run and long-run in macroeconomics. The short run is defined as being that period of time in which the prices of resources, remember resources are factors of production, land, labour, capital and enterprise. Now these remain approximately constant. They're pretty much the same. They don't change as supply and demand changes in an economy, and this is especially true in regards to wages, which we know the price of labour. The long run on the other hand is a period of time when the prices of resources are more flexible and they've got time to adapt as the price level changes, including wages. Our definition for a price level: the current weighted average price of a representative selected group of goods and services. An example is CPI, the Consumer Price Index. We have another example, and perhaps a little bit more important to the concept of aggregate supply. This is a Producer Price Index, a PPI, and this is a measure of the price of inputs that firms in the economy are facing. Let's have a look at these each quickly in turn. We'll start with the PPI, the Producer Price Index.
The Producer Price Index, or PPI, measures the average change in the prices that domestic producers receive for the output they sell. The Bureau of Labor Statistics releases the PPI each month. It reveals trends in wholesale markets, manufacturing industries, and commodities markets. The PPI tracks headline index figures for the crude, intermediate, and finished good levels of production. The crude level reflects the average price change from the previous month for commodities such as coal and oil. At the intermediate level, goods have been manufactured to some extent and then sold to other manufacturers to create a finished good. Examples include lumber and steel. Finished goods are in the final stage of manufacturing. This is the core PPI, and it excludes volatile items such as energy and food. Its prices are the closest to those paid by end consumers. The Consumer Price Index reveals those prices. Costs retailers incur are usually passed on to consumers, so investors use the PPI to predict the CPI and changes in inflation.
Okay, so our Consumer Price Index is by and large our main determinant of how we measure price levels, but the PPI is important to determining how these consumer prices are determined.
The Consumer Price Index, or CPI, is considered the benchmark inflation guide for the U.S. economy. It uses a basket of goods approach that aims to compare a consistent base of products from year to year, focusing on products that are bought and used by consumers daily. The price of your milk, eggs, toothpaste, and haircut are all captured in the CPI. The CPI is calculated by taking price changes for each item in the preset basket of goods and averaging them, with the goods being weighted according to their importance. The index uses a base year for comparability of its calculations, so changes will often be provided on a percentage basis to reflect only changes to prior index levels. There are two CPI figures: the CPI for urban wage earners and clerical workers, the CPI-W, and the CPI for all urban consumers, the CPI-U. The most watched metric is the CPI-U, which is often presented with a seasonal adjustment, as consumer patterns vary depending on the time of year. The CPI is a detailed release with breakouts for most major consumer groups and geographical regions. The CPI is also used to identify periods of inflation or deflation. Large rises in CPI during a short stretch typically signal periods of inflation, and large drops in CPI during a short period usually mark periods of deflation. As well, the CPI is used to make changes to cash flow mechanisms such as pensions, Medicare, and cost of living adjustments. This versatility means the CPI affects nearly every market and person in America.
So those are our two main price indexes, giving us a measure of the average level of prices in an economy. The price of labour, wages, we know. Now wages account for the largest proportion of the cost of production firms face, on average. So as such, the price of labour, how much firms have to pay for the wages of the employees that they're hiring, have a strong influence in determining the quantity of output being supplied by firms. We know that as cost of production go up, supply decreases, quantity supplied decreases, no, supply decreases, and as the cost of production go down, supply will increase. Now average wages in the economy tend to be relatively stable and unchanging, and this is for a few reasons. We have labour contracts in the market, and these often fix wage rates for lengthy periods of time, e.g. a year or more. I have a contract with my employer, and my salary is fixed for 1 year. It's reviewed after that. There's minimum wage legislation, and this will determine the lowest wage that firms can pay to their employees. They cannot legally drop below that. It's fixed. Workers often belong to labour unions, although the importance and the membership rates of labour unions are dropping. Labour unions and the workers that support them are highly resistant to cuts in wages. Nobody wants their wages cut. And employers tend to avoid demanding wage cuts because, you know, they're not good for their workers' morale. Take a wage cut, nobody's happy about it. Nobody's happy about it at all. People start looking for other jobs. And wages are often termed sticky. They're fast to rise but slow to fall. Sticky wages. Moving on to our short-run aggregate supply curve. Now this is a relationship between the price level, e.g. the CPI, which we've just looked at, and real GDP, which is the quantity of real output. And this is when resource prices are relatively stable and unchanging. So the factor prices, our wages, rent, capital and profit, they're held constant. They don't change. If they're changing, we're talking about the long run. So here we are, price level on one axis, real GDP on the other axis. Price level determines real GDP. So Y1, Y2, price level 1, price level 2. As the price level falls, so does real GDP, and we're going to find out why in just a second. Obviously there's a positive relationship between real GDP and the price level. As the price level increases, so too does real GDP. So we know from that as the price level increases, firms start to produce more goods and services. And you can probably have a pretty good guess as to why this is. Okay, why are short-run aggregate supply slopes upwards? Profitability. Again, supply comes down to profitability. So the profitability of firms drives a positive relationship between the price level and real GDP. So if firms on average increase their prices, then what must happen is that the price level increases on average, because this is what the price level measures, firms' prices. If the prices of resources are unchanged in the short run, and they are, or else we'd be talking about the long run, then profitability increases. Prices rise, costs stay the same, profits must go up. And as a firm's profitability increases on average, and we're talking on average across the whole economy, then the output, the supply of those goods and services must increase. This is why the short-run aggregate supply curve slopes upwards. Now, just as aggregate demand could change, we can get changes in the short-run aggregate supply curve as well. And here's an essential statement which often comes up in the assessments and the exam. A change in the price of resources, so we're talking wages, rent, interest and profit, those factors of production, they affect a firm's cost of production, and this affects the profitability of firms at each price level. High price levels, highly profitable. Low price levels, those profits drop. So firms are going to change the level of output they produce at each price level, and this can cause the SRAS curve to shift. A decrease in the short-run aggregate supply or an increase in the short-run aggregate supply. Factors that cause shifts in the short-run aggregate supply in the economy all involve changes to the cost of production. Remember that. They all involve changes to the cost of production faced by firms. So things like changes to the corporate tax rates, subsidies, and sudden events which can be term supply side shocks. Let's look at each of these in turn. Changes in wages. Increase in the price of labour. The wages and salaries that firms are paying to their workers are going to affect the business's profitability. If these increase, profitability will decrease. If wages go down, then profitability's got to increase. So for an example, if an increase in the minimum wage, or there's an introduction of compulsory retirement contributions that firms must make, their cost of productions are going to go up and the SRAS curve shifts left. Changes in non-labour resource prices. So any of these factors of production, the price of the resources used in production processes increase. If any of these increase, then the SRAS curve will decrease. So for example, if the price of capital equipment, oil and other commodities which are quite often used in manufacturing and producing and delivering, transportation, the price of land, if that goes up, the profitability of firms is going to decrease as their cost of production increase. Changes in business taxes. In most countries, odd exception, Saudi Arabia, you being one, businesses pay tax on their profit. These are corporate income taxes, and these taxes affect firms in the same manner as cost of production do. So the higher the tax, the higher the cost of production, a decrease in the SRAS. Decreases in corporate tax rate increase the short-run aggregate supply. Changes in subsidy work in a very similar way to business taxes, but just the opposite. So if we get a subsidy in place, that increases the profitability of firms, and the SRAS curve is going to shift to the right. That means it's going to increase, and if subsidies are withdrawn, then we'll get a decrease in the short-run aggregate supply. Supply side shocks. Now these can be a whole variety of things, but what defines them, it's an event that suddenly increases or decreases the supply of goods and services in general. And this sudden change affects the equilibrium price of the goods or services an economy is producing on average, and this the economy's general price level. Things that can be classified as supply side shocks include natural disasters such as earthquakes, tsunamis, floods and droughts. Occasionally a currency will collapse. I'm looking at you, Venezuela, at the moment, and imports used in the production process become prohibitively expensive. Short-run aggregate supply is going to decrease.